Hello and welcome to another video as part of the technical analysis series. Today we're talking about the daily open trade strategy. Here's the outline for the video. We'll start with the Candlestick Refresher, we'll cover some core mechanics, we'll talk about using the daily open for continuation setups, i.e. when you have an expectation for trend day, trend days, or expansion more generally. We'll talk about candle open drives, some nuances, and then conclude. Usual disclaimer, this is not financial, investment, legal advice, or advice of any sort. It's just a YouTube video, entertainment purposes only, and, talk to a lawyer or something. So, refresher on candlesticks. If this is new to you, then I recommend you go back earlier in the playlist, which one of the first videos has the title of Introduction to Candlesticks or something of that nature. Watch that and work your way down here. This video will assume some prior knowledge, but it's all prior knowledge you can get from the playlist itself, so see you back here later if that applies to you. If it doesn't, let's continue. The first useful observation we'll make is that most markets tend to trade either, or particularly both sides, of the open on any given day, and that's simply to say that most daily candles have a wick. It's a bit of a sort of banal observation, but an important one. If you go to ETH USD on the daily, most candles, with some recent exceptions, have a wick on both sides, regardless of whether they're green or red. Doesn't matter if the market is moving sideways, trending up, trending down, whatever, that observation on average tends to hold true. Same for BTC, same for alts, and so on and so forth. Why that is useful will become obvious sooner rather than later. Final bit of housekeeping is that the daily open is at midnight UTC. Most of your charting software should be able to tell you when the daily open is. You can get indicators on TradingView. You can simply change your time zone to UTC and know when that is, but nothing too complicated there. And the acronyms we'll be using for this video are the following. DO is daily open, HOD, high of day, LOD, low of day, fade just means stepping in front of a big move, so selling a move up or buying a move down. HTF is high time frame and LTF is low time frame. Here's our diagram courtesy of IG.com. When you have a green candle, regardless of what time frame it represents, the closing price is higher than the opening price, and the tails are the highest and lowest prices traded within whatever session it's representing. But the core part is a higher closing price than the opening price. And the same for the red candles, just in reverse essentially, where it's red because the closing price was below the opening price. Okay. Now, when we talk about daily open setups for continuation, there's an important requirement that I think helps, and it's to have a high time frame directional bias. I will even put this in brackets because having a high time frame directional bias is not a prerequisite. It certainly helps, but having some sense of a directional bias is important, and that'll become obvious why momentarily. Now, the assumption when you have a directional bias, or what it means to have a directional bias, is the following. You're essentially saying, if we take the daily example, that today, if you have a bullish or bearish daily directional bias, you're saying today is likely to be a trend day, or today and the subsequent days are likely to trend. And the inference there is that the trend portion of the day will occur above or below the daily open in the direction of the bias. So quite simply, if you think for whatever reason that today's daily candle is going to look like this, at some point the market has to trade significantly above the opening price and close higher for the candle to be green and for you to be correct. And of course the opposite for if you have a bearish directional bias. If you are correct, at some point the market's going to have to move lower from the opening price and close at a lower closing price in order for your view to be validated. Now, the setup, all these we'll cover a bunch of nuances in a moment, but the setup, mechanically speaking, is rather simple, where essentially you're looking to buy a reclaim of the daily open on a bullish trend day, or sell a move back below the daily open on a bearish trend day. And another benefit of this is you get built-in invalidations with these things, where if you have a bullish directional bias, your low of day is the stop for a bullish trend day idea, and if you have a bearish directional bias, the high of day is your stop on a bearish trend day idea. Now, going back to something I said earlier, why is having a high time frame directional bias an important sort of criterion to satisfy? And it's because if you take this setup sort of mechanically at face value, you end up with quite absurd conclusions. So consider the following. If we took this in the most literal sense, let's see if we can bring this up. Oops. Okay, doesn't matter. Let's say you have this. You're taking this literally, and it's quite nice we have it on the page anyway. So this is your daily open, okay? And let's say you don't have a directional bias, and you're only following the setup portion of buy a reclaim of the daily open or sell a move back below the daily open. What that wouldn't mean necessarily is that as soon as you see this, a little move back below and a move back above, you would think, okay, well that's the setup, okay? So I'm going to long this. I'm going to put a stop at the low and target higher. And it would mean the opposite is true for the bearish setup, where if it goes higher initially and then is back below, you would short it below the daily open, you'd put a stop above and target lower. And hopefully you can already tell the absurdity of this exercise, because if we were to look at the daily open on, say, BTC USD, that setup wouldn't be particularly great in most cases. I mean, certainly here, it would have worked, right? If you, for example, had a drive lower, as soon as above the daily open, you're a buyer with a stop at the low, sure, that works. But then if you take a larger sample size and see how messy and choppy the market tends to be around the daily open, you'll see that applying the strategy mechanically turns into a bit of a nightmare. Yeah, it's just, without context and without the requisite filters, applying this type of setup just blindly doesn't tend to work particularly well. And there are a lot of charts on social media which simply have the daily open as a level without any context and just use it as support resistance. And I think, put charitably, that is misled. So you can hopefully see where if you just kind of chase the first tiny move off of the daily open or the first reclaim and just smack a stop, 1, 2, 5, 10 ticks higher or lower, on average, that will be a losing strategy. Okay, and you can say the same for ETH. The market tends to be very choppy and sort of push above, push below, and it's not always as simple as, well, this is the daily open, use it as a support resistance pivot. Thanks for watching, like and subscribe. The evidence doesn't support that. So how can we keep the useful idea of having the daily open as a pivot, but apply the sort of appropriate context to it to make it tradable and worth our time? Now, before we get into a bunch of context, and we also have a ton of chart examples to go through as well, I want to give you the paint version of what I'm talking about. Here we go. Now, essentially what we're saying is the following. Let's say our directional bias is bearish. Bear. Okay, so what we expect, and just to keep things simple, we're going to take the daily example. What we expect the daily candle to look like is the following, right? So we have a bearish directional bias. We think the day is going to close lower, and maybe the subsequent day is going to close lower. But this is our expectation of what the daily candle is going to look like, right? Now, with that in mind, if we take the daily open, something interesting happens. So we have the daily open here. Okay, what we're essentially trying to do is capture the body portion of the candle as it's forming in real time. So again, bear in mind it's a red candle, so this is the opening price, and this is the closing price here, and this is the high and the low. So if this is our daily open, we have a bearish directional bias, and we're trying to take this setup. We're tracking the high time frame candle in real time. So if we are correct, let's say the market fulfills the first criterion and drives higher from the daily open. What we're expecting this move to be is the wick portion of that daily candle. Okay? As the market loses the daily open, and we'll talk about timeframes, all the other details in a moment, as the market loses the daily open, we expect to be here somewhere, right? So we've formed the high of the day. This is the daily open, and we're now below it. And when we're entering a trade somewhere below the daily open or where it's acting as resistance, what we're trying to do is capture the candle body portion of the setup before it unfolds. So ideally, if this is our expectation for, this is our directional bias that the candle is going to look like this, what we're really doing is trying to enter somewhere around here, close to the daily open, and we're trying to capture as much of this candle body as possible. So hopefully that makes sense. Let's get into the nitty-gritty. And again, tons of chart examples coming your way. First, a bit more theory. Bear with me. What does it mean to have a high time frame directional bias? Again, I don't mind if you just remove the high time frame part and talk about directional bias in general. I will say read the article on Medium about directional bias. It'll be in the description. But in general, the basic definition is a strong brackets high time frame signal that the next days, weeks, or if you're using it on a lower time frame basis, sessions will move higher or lower. Higher or lower, right? i.e. higher than usual conviction in direction. And what are some examples of that? And it's hopefully things that already exist in your trading system. So breaks of key levels, failed breaks of key levels, reclaims or losses of key levels, candle closes or evidence of absorption at important contextual areas, breakouts and retests of high time frame market structure levels, i.e. areas where you could reasonably expect a higher low or lower high to form, gain or loss of MA-based trend, momentum divergence, all the usual trading stuff that we use to generate signals, all of that applies here. We're just trying to add a filter to the price action instead of using that daily open tail chasing absurd example we talked about earlier. Now, when it comes to the reclaim of the daily open, because again, all I'm doing is kind of just breaking down these steps, because this is really the only slide you need. But as we've seen, if you apply it in a vacuum, you end up with quite unfavorable results. So we've hopefully covered what high time frame directional bias means. And again, the article does some heavy lifting there. Now, as far as the following, reclaim of DO, we know that if we're bullish, we're buying the, move lower and we're above the daily open, we're buyers. And if we're bearish, move higher and move back below the daily open, we are sellers. What does that really mean? And it means the following. When I say reclaim of the level, so again, what reclaim essentially means is if we're bearish, by reclaim we mean it's above and now it's back below. Let me make that actually visible. I'm sure that would be helpful. So if we're bearish, all that means is we were above and now we're back below. Or if we're bullish, that means we were below and now we're back above. Okay, that's all that means. Now, in the past examples, and we'll talk about charts in a moment, I just simply kind of circled this area as being where you'd enter, but of course we need more detail than that. Specifically, I will say that your entry is usually on your standard intraday setup timeframes. A lot of traders will have like execution timeframes or timeframes on which they execute their shorter timeframe strategies, or even sort of look for setups for their higher timeframe swings. And for our purposes, that has to be a lower timeframe strategy, specifically timeframe wise. So that can be the 5-minute, the 15-minute, the hourly. These are the three I use the most, mostly for daily open entry trigger stuff. It'll be either 5-minute or hourly, oddly enough, but something lower time frame that you can actually track, monitor, I think is helpful. The second point I'll make is it's worth treating the daily open in those cases as an SR level, and you want to apply the usual entry trigger techniques in the video. So sometimes, just chasing the breakdown or the breakout is appropriate. Sometimes a retest is appropriate. Looking at lower time frame patterns above the daily open if you're bullish or below if you're bearish. Kind of fractal type price action is also appropriate. There are full videos on this stuff. One important nuance that applies specifically to the strategy is point number 3, that you should be prepared to trade around that level more than once if necessary, because sometimes it can get choppy. We are dealing with usually sort of higher time frame levels and areas where the market can take a while, and so it's not the end of the world if the market kind of chops before giving the move that you're looking for. Now, as far as invalidation goes, as we mentioned earlier, it's essentially built in, which is helpful. So it's the high of day if you're a seller and the low of day if you're a buyer. Sometimes the market will give you a better or clearer invalidation, which we'll talk about in some chart examples. And it's also not uncommon to get a spike. So again, setup-wise and sort of from a risk management point of view, you want to be sure that you're in a spot where you can take a couple of stabs at this thing without getting stopped out, right? So you don't want to risk 5% or something on just a single daily open strategy, get wicked out, and then it plays out again, but you don't want to risk 10% on the same trade. So give yourself some leeway there. Yeah, let's talk some chart examples and talk through it. So the slide I want to have here will probably be this one. Okay, so we can we have the setup and validation, and we will go through charts and see how it applies. So here's BTC USD on the daily. Market is at a resistance level at the time $28,700, and we're back below and retesting that level. So directional bias in this case will be bearish because the market is at resistance. Sometimes it's that simple. Now, if we have our daily open marked, we can see the following. So this is our daily open. The market drives lower initially, fine, sells off from the open. Maybe you feel bad for FOMO, like not chasing this and thinking, oh, well, the big move is done now and we're just moving lower. However, look what happens. So the market then drives in, and at this portion of price action, it does two things that are important for our purposes. And it happens on both occasions, actually. The first thing it does is it trades above the daily open. So the purple line is the daily open. So all of this price action here is above it. So per our diagram of being bearish, this we expect to be the wick of that high time frame candle. Then when it breaks down, which happens here, on this occasion it gives you a nice retest of the daily open. So your entry trigger, in that case, you'd be rewarded for if you didn't chase this and had a limit order, that's fine. So that satisfies the criterion of moving back below it. and then your invalidation automatically and mechanically becomes the highest high made, with the target being whatever your broader directional bias is suggesting. So as I said, from support to resistance, from MA band to MA band, overbought to oversold, what have you, one side of the range to the other, all of it being the same thing. And you actually had a similar setup play out twice at that level, which isn't unexpected if you're dealing with daily levels where the market can spend some time there before actually giving you the big move. But same thing here, and this is actually on the same day as well, which is interesting. You have the daily open, market moves above it once again here, but notice it's not just moving above the daily open. We're not doing that thing where we just draw the level, and if it's, if it breaks down, we sell it, and if it breaks up, we're buying. We have the context that the big blue level is a daily level of resistance, okay? And notice how the market isn't just trading above the daily open, but it's getting stuffed at that daily level of resistance. But mechanically, very much a similar thing going on there, where it hits the daily level, then loses the daily open. And the reason I included this example here is because this is one of those where you would initially, at least, likely get spiked. Because if you followed, let's say, this breakdown candle as an entry trigger, your invalidation mechanically would go at the high, and 2 candles later, you get stopped out by this wick, which is why the point about being flexible and being able to take the setup more than once is important, because after that spike, you can see the market comes in and tests the daily open again, on this occasion, before giving you the move that was favorable. So yeah, that's one example of it. Now you can see how we sort of built up the idea, right? Sort of using all the principles that we discussed. We have the high time frame directional bias because we know it's at daily resistance. We had the move above the daily open, which we expect to be the wick. We have the loss of the daily open with invalidation at the high, and then you get a nice move in your favor. Here, this showcases the same principles, except with the spike, you also later get a re-entry opportunity before the market trades lower. Okay, but it goes back to that same diagram we talked about of, if our expectation is that the daily candle is at some point, or more likely than not, going to look like this. When the market is doing this, you are here. When the market is doing, this portion, right, losing the daily open, you are here-ish. And the move that you're trying to capture is the follow-through having flip the daily open. And I'll keep doing this to sort of reiterate the point, but hopefully that's one good example. And there are more, because I know you like examples. I do listen to your feedback. Here's Cardano, an example of a different directional bias, which is a sort of failed breakout and retest, where you had a level of resistance, market comes in, tries to break out, not accepted, and back below it, right? Sort of breaks down below here. You get a retest on this occasion, retest on this occasion. So if we look at that on the hourly time frame, again, directional bias, we'll have our mental note of what we expect the candle to look like here. Okay, red, with this being the opening price and this being the closing price. What we have, marking out this daily open, doesn't meet our criteria. Initially, you get a drive above the daily open. Crucially, where is that drive taking place? Is it in the middle of nowhere? No, that drive above the daily open is into daily resistance. So as you're getting this portion of the move, you're thinking there's a chance that we're here. Okay? Then the market gives you an hourly signal and it closes initially below the daily open on the hourly time frame, and then comes back, and notice it keeps getting stuffed at daily resistance. So already, in terms of entry triggers, as per the video, you could do something as simple as hourly close below as an entry trigger, because it hit daily resistance and closed below on the hourly, so that could be sufficient. And we know that the invalidation on that occasion is a mechanical stop to start with at the high of the day. Okay? Market comes in, keeps retesting the level, so another option could simply be on this second breakdown, you're a limit seller either of the level or of the daily open, because we know this is the breakdown signal, so we're allowed to be sellers. It's just a question of how do we sell. Is it hourly close below? Appropriate. Limit order at the daily open? Appropriate. Limit order at the resistance? All appropriate, right? This is stuff for you to figure out, and there are options, there are videos on this as well. It depends is always the best answer when it comes to entry triggers, and also to be completely candid, it may seem like a big deal, but whether you enter at the daily open or even slightly below or at the level, this isn't going to make a ton of difference ultimately for the purposes of our trade idea. Okay. So if we're talking about this bit of price action, as the market has broken down below the daily open and is retesting it, you're hoping, if you're correct, that you're somewhere here. And then as the market expands lower, your expectation is to catch this portion of the move. So again, very straightforward. We built the idea off of we have a high time frame bearish directional bias in the fact that the market's failed to break out and it's sort of retesting resistance. Our lower time frames satisfy the requirements for the setup because we have a move back below the daily open on a bearish trend day. And we have a move back below the daily open on a bearish trend day. You have two occasions, technically. You have this hourly close below, and then you have this hourly close below as well, all while, again, contextually respecting the daily level of resistance. Your invalidation is the high of the day, which is here. On this occasion, didn't give you any trouble. And target is whatever move you're looking for. Sometimes it will just be as simple as if you have a high time frame directional bias, you have a high time frame target. That's what makes the setup quite attractive. You essentially get low time frame style defining risk with a high time frame target, and that's how you get very high risk to reward setups. Or you're simply almost ignoring the higher time frames as far as targets go and say, I think this is a really good setup, but I'm not sure if this is going to be the big daily move. So, I'm going to target, hourly, 4-hour, 12-hour support instead of daily, weekly, whatever support. Okay, so basically using this strategy for smaller moves instead of for swing entries. Here's another example on BNB, a similar type of setup where you have a level of resistance or a range high initially. Market tries to break above it and ultimately fails, and this turns back to resistance again. So what can we do? We can map out a couple of daily opens, given we spent some time at this level. The first one is here, and this kind of shows some of the squeeze examples that we've discussed. So consider the following. You have daily open, and it's just complete chop. Right? Complete chop initially, and then if you sold this breakdown, and you kind of apply the strategy mechanically, chop, 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 breakdown, you put a stop at the high of the day, which would be, somewhere around these highs, let's say, and then your entry was below the daily open. That's your stop when you're targeting lower. This takes you out. You get completely squeezed. So again, if you're using those really aggressive high-risk models, you don't want to do that, because what happens after is the market just completely collapses as a result. And again, this is on 15-minute to give a different example. It completely collapses back below it and sort of breaks support in doing so. And then you get a significant move lower, rather. This, I think, encapsulates a couple of the concepts we talked about. First is that, again, don't want to over-risk on these setups because it can get choppy. And the second point that it makes with regards to this strategy specifically is that a lot of the time the mechanical stop the market can at times offer you better options. So let's say the market sort of broke down. You want to take a chunk here on this break of support after the squeeze. And so you look at the slides and mechanically they say your stop goes at the high of the day. However, at that point, the high of the day is literally up here. And that would really start to compromise the risk to reward ratio or the payoff of the trade that's available to you. So that's an instance where you can exercise some discretion and say, well, look, in this context, we have a big breakdown fuck off candle here that ended up breaking this level of support. So instead of using the mechanical stop at the high of the day, I'm going to move it down somewhat and use it at the high of the thrust candle that broke the level instead on the 5-minute, 15-minute, whatever it may be. And that can sort of tighten up the risk reward ratio and make the setups more palatable. Okay. And then the market came in and retested that level again. A slightly more straightforward example where you have your daily open. It immediately drives higher into resistance and then breaks down on the 15-minute here. This one is a bit trickier because if you were waiting with limit orders at the daily open, it goes unfilled and you might have felt uncomfortable chasing this. But that's just a lot of trading. You never know what the perfect entry trigger for your setup was going to be. Sometimes your limit orders will get run over. Sometimes you're waiting for price action to show you whether it's bullish or bearish, and instead it just V-reverses and leaves you in the dust. I think you should have a range of options, and all those options are covered in the entry triggers video. And it's also sometimes worth asking if it makes a difference, right? So as we covered in the other Cardano example, sometimes the difference between leaving a limit order at the level and taking a market order slightly below it is basically immaterial. And if you think the setup is good, then it's kind of worth crossing the spread to make sure you can put the trade on instead of the market just kind of going without you if the difference itself between those two orders in both kind of price and cost isn't going to be too great. On this occasion, again, if we're using the 15-minute, close below is what technically makes it valid. Invalidation, again, one of those where the high of day is your mechanical one, but you'd be forgiven for using something closer to the daily open itself. And then the market basically moves sideways for a bit and then trades lower. Okay? Let me see before I cover these examples whether there are others. Let's progress the slides a little bit. Hopefully you have a sense for this thing now. When we're talking about the daily open for continuation, I think this technique has two subcategories. In particular, you're either catching the impulse at structure, i.e. the market is at a key contextual level but hasn't reacted or moved yet, or you're catching the impulse away from structure. So colloquially, without even reading the rest of the slides, or at least the first half, for type 1, you're saying the market is at a key level, and I'm going to use the daily open as an entry trigger. For type 2, you're saying we just broke support, I think we're really fucked and the next few days are going to go lower, or we just broke resistance, I think the market is really strong and the next few days are going to move higher. So one of those, you're using it at structure, the other one is away from structure. Okay, so if we add some examples of that, it's basically all we're left with. So let's take a few of these. With Pepe, which was a trending meme coin around the time I started making the slides for this, you had a big breakout on this candle here, right? So whatever chart structure there is, I mean, if you just kind of take all-time high type of stuff, you had a big breakout on this candle. So you're thinking, okay, well, this is the daily close. I really think the next few days, unless I'm wrong and the market deviates and goes to zero, I think they're going to be up days. So how can I take a piece of that? So usual stuff, you map out the daily open, and again, this is some of these are clearer than others, but on the 5-minute here, which is what you have to do with particularly trending markets, this example is probably way too sort of hindsight fitted. You have the daily open, it moves lower, reclaims, and trades higher. I mean, this would be like a 10 trillion R trade, so I'm slightly less sure about this. It's probably, if you were sitting at your desk at the time, you probably would have thought it was noise. Something that's a bit better is this one here. So again, same thing. Directional bias is bullish, and so our expectation for what the daily candle is going to look like is the following, right? Our classic good old green boy here. So this is our directional bias. Okay? So, what are we left with? Market opens, initially moves higher, actually. So you might be thinking a bit sick to your stomach, thinking, oh, I knew Pepe was going to go higher, but I was waiting because I watched Cred's terrible video and now I'm sidelined. However, then the market comes in and trades below the daily open. So if your directional bias is correct, at this point when we're here, your expectation is that you are here. And then when the market reclaims the daily open, so sort of starts trading above it, your expectation is that you're somewhere here, that the low of the day has been made and you're in the early portions of the candle body. On this occasion, it actually comes in and retests it. However, regardless of what entry trigger you used, whether it's we're back above the daily open now, I'm going to use a market order, or whether you were a limit buyer at the daily open itself, as we know, the mechanical stop goes at the low of day, which is here, and regardless of your entry trigger in or around the daily open, that remained untagged. And then the rest of the trending move is what we're targeting using this strategy. Okay? The opposite example of that, actually, I think this is like one of the slightly clearer ones. This is similar to Cardano and BNB. You have this level on near on the daily chart. The directional bias that's present is that the market has formed a really bearish daily close through a key level. So you basically had support, resistance, looks like a breakout, but hey ho, you have a daily close back below it. And it's not just a daily close back below it, it's a bearish engulfing that also sort of spiked previous day's high and then closed below the level, as bad as it gets, right? So you're looking at this daily candle here after it's closed and are thinking, I think this thing is going to move lower. How do I catch a piece of that? Well, you do it, hopefully, using the daily open strategy. And again, very similar stuff as per our setup slides, right? Sell move back below daily open, invalidation, high of day on bearish trend day. So how does that manifest on this occasion? this is the hourly time frame here, so you can see we have examples of the 5-minute, the 15-minute, the hourly. It really varies. Sometimes I'll prefer to use the hourly if I can, but a lot of the time it's 15-minute as well. But it's all three really. Hourly if I'm getting old, so hourly time frame if the market lets me get away with it. But on this occasion, you have the daily open, and I've just used the hourly here. There's a bit of a wick that makes things a bit unpalatable, but bigger picture, right? Given we don't really mind this because we're looking to sell moves back below the daily open. So if it just wants to dump off the daily open or do whatever, that's fine. Let's look at it for our purposes. So again, I'm going to do the annoying thing of having the directional bias candle visible on the screen. This is what we're looking for, right? This is what the daily chart is suggesting that this price action is going to look like. Daily open, market immediately rallies into resistance. Right, this is our daily level that we talked about. Market rallies into resistance here, okay? And then, crucially, where does it lose the daily open? So technically, you could argue that this is enough, and your entry trigger is at the high of the day, which at that point is like here somewhere. I will add the proviso, however, that while purely technically that's valid, you've seen in the other examples that if you're taking this at a level, the market really likes to come and test those levels. And the reason, for those of you who've watched my videos for a while, that stop idea should hopefully offend you is because you're putting a stop at resistance. So you're putting a stop for a short at resistance. So if the market goes there and turns around, you'd feel really stupid, because if you're short and you have a stop, that's an order to buy. If you have a stop in this occasion for a short at resistance, you're putting in an order to buy at resistance, and that's a bad idea. So you wouldn't do that, hopefully. And if you were patient with it, the market actually just pushes into the level. Oops, that's a big arrow. The market pushes into the level. You get some crazy wicks and price action that's showing no evidence of acceptance. It's just all hourly closes below. And then I think the more visible part of the strategy is here. You get the hourly close below the daily open. Mechanically, your invalidation would be the high of the day, which is here on this wick, although I think you'd be forgiven for using this pre-breakdown candle as well. And then your target, and again, there's a video on the channel on FTA, first trouble area, which is all about profit taking. That's why I might feel like I'm skipping past a lot of concepts, like specific entry triggers, retests, first trouble areas, but there are videos on the channel for all of it, so you can just piece it together. That's kind of the point of having a course. In any case, once you get a close back below, notice that the next candle squeezes you, right? It's nice and green, but ultimately it doesn't matter. It doesn't even reach resistance, certainly doesn't take out any mechanical stops, and the market just proceeds to move lower. Okay, so when this portion is happening and the daily resistance is being tested, your idea is that we're here. When you get a close below the daily open, your idea is somewhere that we're in the early portions of this. And then the trade idea is that if you're correct about this candle, this is your stop, this is your entry, this is your profit. Okay. Let me see if I want to. Yeah. So more examples. Pepe, we're done. Near, we're done. A couple more. So another example of the type 2 setup where we're trading away from structure is ETH. Big level at 1700, and you see this daily close here, right? Think about it from this point of view. We have support, breakdown. First daily close below this level in a while, and you're staring at it thinking, well, basically you are here. And you're thinking, this doesn't look good, and I think there's a chance that the next day or days are going to move lower. So the directional bias criterion is satisfied by the fact that you've got a daily breakdown as your basis for that, okay? Now, with the daily open in mind, how did that unfold? It tended to be fairly charitable, actually, on this occasion. So this is using the daily open indicator on TradingView, and this is that 1700 level. I think this is a bit generous as far as catching it, but you have initial drive off the open and then loses it immediately. So purely mechanically speaking, you would be on the 30-minute time frame a seller of this breakdown with invalidation at the high and just targeting a lower day of trading. There wasn't a ton of profit from this, kind of just went sideways. And again, if you look at the next day, similar type of thing, slightly choppy on this occasion, where you have the daily open, and instead of driving higher and the market moving below it, you just kept finding resistance at the daily open initially, sort of drives off and then comes into the level and then dumps, right? So sometimes I think that the point of including this is that the reason you have to take small risks, unless you have very clear sort of invalidation for these things, is that sometimes the moves will just be so small, and this kind of the initial drive before the loss of the level is so minor that you simply can't risk large amounts with like a 5-10 tick stop. It doesn't make a ton of sense. And other times it just gets a bit choppy and hard to follow through. But as long as the core idea is there, it's a better than usual way to act on that bias. Because look, if you saw this breakdown and your idea was I'm going to sell a retest, you sort of missed out on the biggest down days before the market went sideways and reversed. So you sort of give yourself a chance to catch trending moves even as a levels trader. Admittedly, this example being a bit rough. One that I think is better is this ETH USD one, where you had the directional bias on this case is bullish because there is a reclaim of a key level. Those of you who watch the streams sort of know this setup very well. You have support, breakdown attempt, and then the next day just super engulfs the whole thing. And so again, the idea is you're looking at this candle thinking, wow, this should have really dumped. This is a really big engulfing. I think it's going to follow through, and a bunch of people are trapped at the lows. So how do I catch a piece of this? You map out your daily open, and looking at the price action, again, applying the same good old model of our directional bias is such that we expect the candle to look like this. Okay, here's our green boy, with this being the open and this being the close. So how did it unfold? We have our daily open, okay, on this move. Initially moves lower and then higher. So if you were to apply that right off the open, which I don't like doing in general, but very mechanically, you'd be in this type of trade with invalidation and entry trigger somewhere here. Congratulations, you bought the top. Rough, okay? However, how did it unfold after that? And this is why I don't like trading the daily open immediately after the open itself. And this is something we'll come on to in the videos. You can see the market comes back and does trade that level and presents you with much clearer price action, where it tries to break the daily open, moves back below it, reclaims it, and this is on the 15-minute with this breakout move here. Your mechanical invalidation would be at the low of the day, which is this move here, and then target basically a trend day, right? Or just to put on a position or whatever it may be, whatever your high time frame directional bias is suggesting the direction of the market is going to be. And again, even if you want to get more nuanced about entry triggers, if you took a market order on a breakout above, that was fine. And on this occasion, if you limit bid the daily open, that was fine as well. Is that all I wanted to say? Yes, it was. So yeah, ton of examples, but just to reiterate the two different types, with the BNB, Cardano, Near examples, you're using the daily open as an entry trigger to do business at structure. That, hey, I've got a bias that this thing is going to reverse, but it hasn't reversed yet, and I want to punt a position, have it be risk defined and with an invalidation built into it. With the second type, it's, hey, we just broke, I think the market's going to trend because we've broken down from or broken up from a key level. I don't think I'm going to get a retest, but I want a piece of it in case it doesn't pull back. And most often seen at after large or failed breakouts. And with the first one, it's mostly seen, as in our examples, at high time frame levels where sort of the market is more likely to spend more time at the level before giving you a reversal. One other type of mean reversion that is also tradable, but I've dedicated less attention to, which I'll talk about, is candle open drives. So mean reversion setups may become available when a market offers a fast one-sided move away from its opening price. You see this on the hourly, daily, weekly, very much similar timeframes. Generally speaking, I found myself trading these less frequently and with less success over time. Used to be almost free money, sort of. There was always a daily open drive and it was fadeable, and especially on the 4-hour, you used to have a lot of brainless 4-hour candle drives with algos chasing it, and those were fadeable back to the open. But over time, I think that's deteriorated. It may come back, which is why I've sort of included this, and there are still some very spicy daily open drives that are worth trading. but I think it's a much smaller part of my system than the other stuff, so I've spent less time here. So essentially, the setup or the application is the following. If you go back to our original observation that the market is likely to trade both sides of a given candle open, especially if you're talking about the daily time frame. So this is the open. What I'm essentially talking about is the market just immediately off the open driving up one side, having spent no time below. And if you have a model of a candle that just has a wick on either side, you're saying, hey, the candle doesn't look like this like most candles should. It actually just looks like this, and there's nothing here. And so the trade idea in general is to sell that down into the daily open such that you have a wick on the candle, okay? And it works in the other direction as well. Let's say you have an open and the market just drives lower immediately and you are here. At the time, the candle looks like this. Hold on, my brain has just completely, here we go. The candle looks like this, okay? It has an open. It dumped immediately off the open. Presumably it has a low, but it's only got a wick on one side. So your idea is to fade or mean revert it, if you will, higher in order to trade both sides of the daily open. That's really all it comes down to. You can have this on the 4 hour, the hourly, the daily, what have you. And the basic premise is that most candles on most timeframes have wicks on either side. This candle just drove off the open, and it's likely to come back to it and sort of fill that in and mean revert towards that area. And yes, as I've said here, the mechanical setup is to fade any drives targeting the candle open on the other side. So if you have a daily open drive down, you buy that targeting the daily open higher, right? As in the latter example, and the other way around. If you have a daily open drive up, you sell it down targeting the daily open. Now there are some obvious difficulties with this, and they are as follows. And this list isn't exhaustive by any means. Now it's not unusual for trend forming moves to start with a drive. So while it's often and usually the case that, especially on the kind of higher time frames and certainly the daily time frame, most candles will trade both sides of the daily open. Sometimes you just have someone completely just ape in at a certain time, and the market impact is such that it just sort of gaps up and doesn't have a wick, and the price action isn't very efficient, and it's a bit of a thin move. But because it's such a large order and the momentum that it instigates as a result, the market just doesn't revert, and it's actually the opposite. It's a trend forming move rather than a mean reverting type of thing. So that's an important consideration. The other difficulty is that, unlike the other strategy, it's much harder to find a clear invalidation for this thing. So if we take our example of sort of the daily open drive lower, this is our daily open, and the market just drives lower, and you're somewhere here, how do if you're going to target the other side of the daily open so that the market has a wick on both sides, if you will, where's your invalidation for this? There's not, unlike the first one, there's no sort of mechanically clear area where you can put that. Now, of course, if you're looking at this on lower time frames and then it breaks down and does a reclaim, maybe it gives you that, or maybe you've got like a high time, a sort of lower time frame on this occasion, level of support that you're willing to trade back towards the daily open, and that gives you an invalidation. All of those are viable, but it tends to be a bit messier and far less clear than the first setup presented. The final point I'll make is that the difficulty with candle open drives, specifically around the daily open, as we've discussed, is usually the moves are much smaller and noisier, especially if you try to trade this sort of every day as a mechanical strategy. There's just a lot of chop and churn around the daily open, so it's not, I think, at face value the best idea. It's one of those things where you'll be able to quite easily identify a good daily open drive if you see one, but a lot of the time the market just opens and doesn't move enough to make the mean reversion likely, or it opens and it just immediately chops both sides of the daily open, and the idea doesn't really go anywhere. I mean, there are a lot of messy examples here, so that's something to bear in mind. However, that doesn't mean that candle open drives are completely useless. I think there are some useful applications for them. I've got three that I'd like to mention here. The first is just keeping in the back of your mind that if a candle is wickless, there's a higher likelihood of the market trading there, and also just a bad idea for stop placement. So for example, if you have a bullish directional bias and there's a daily drive higher and you just market buy that thing and you put your stop at the daily open, maybe that's not such a great idea, because as we've seen in countless prior examples, even if your directional bias is correct, there's a good chance the market's going to trade both sides of the daily open. So it's a nice little sort of potential mean reversion thing to keep in your back pocket, or to have some understanding of where that is and that it could come down and get backfilled. That's why I'm not a huge fan in most cases, of chasing the market in the direction that it's wickless. So if there's a drive in one direction, even if I'm not going to step in against it, I generally don't like chasing it. I think another application of candle open drives is that it can give you confluence for other ideas. So for example, you have a daily open drive into daily resistance with a bearish directional bias, so all the stuff lining up. If you're trading it for a low time frame punt instead of the high time frame basis for it, you could just target the daily open for a little mechanical trade strategy. I've done that from time to time. It's quite cathartic. And another example of confluence is the market breaking down just at the daily open, like midnight UTC, which is generally a less liquid session. And you probably don't want to chase that with a tight stop, as we discussed, because we know that there's a good chance the market will come back and at least tag the daily open, even if you're correct. And just in general, especially if the candle open meta comes back with these wickless hourlies, 4 hours that come in and backfill with great consistency, they make for... these candle open drives make for good mechanical targets in mean reverting markets generally, especially if you're low time frame trading and you're fading a move. Sometimes just seeing where the higher time frame candle opens are can give you a high probability or at least a very straightforward target. So here are some nuances. I think the first one is the daily open move needs to be a visible drive, or at least a loss or a reclaim, or whatever the context mandates, and not some tiny low time frame wick through. So even when we were engaging the examples on the 5-minute, 15-minute hourly, it wasn't just kind of chop and churn and noise or 1 minute closes below. You want to see good enough evidence of a loss of that level if you're bearish, or a gain of that level if you're bullish, like you would with any other support resistance type of thing. Point number 2 is do not assume that every new day will have an actionable daily open setup. As we said, pretty much the most important part of at least the first setup is having some sort of direction bias or some sort of indication of where the market's going to go, because otherwise you just start chasing every move above the daily open, you're a buyer, every move below the daily open, you're a seller, and then if it, just flip-flop, and it ends pretty disastrously. So I know it's tempting after learning something new to go look for a million examples across every single trading pair to trade it, but often not the case. The context needs to be there first, and then this becomes a much more useful tool. I will say that you can apply this candle open logic to other time frames. So the hourly, the 4 hour for intraday, weekly and monthly opens as well, sort of world's your oyster for that type of stuff. I just find that if I have a high time frame directional bias, I generally prefer for that to come from the daily or the weekly. Sometimes it's monthly, but monthly levels are just a bit more rare, but if it's there, I'll take it. Daily tends to be the most common one. So what point was I making there? Good Lord. Yes, it can apply to other time frames. My preferred time frames are specifically daily open for directional bias, and then hourly and 5-minute are my preferred execution time frames, but you can sort of expand to other time frames also. All aforementioned confluence factors help, and the core of the setup sort of relies on confluence factors. So support resistance, previous day's week, so previous day or week, high and low, all of the sort of price action stuff that we've covered in the channel, covered in the top-down analysis video, covered in the entry triggers video, covered in the directional bias article, link in the description. All of that is, I think, a prerequisite to make sense of this. And you can see I'm really passionate about this point because, again, even the last bullet point is about the same thing of don't be a drone drawing the daily open devoid of any context and using it as support resistance. Not the point. Conclusion. How are we still doing this 5 years later? Although I think it's actually 6 years. 2017 December was the first video. So yeah, 5-6 years later, we're still here. I do appreciate the small gesture of liking the video, subscribing to the channel. Even if you're just watching after all this time, I'm grateful that you think this is important enough. Hopefully it hasn't been a waste of your time. Unfortunately, or fortunately for some of you, depending on what you thought of this video, there are plenty more updates planned, even though it may not seem credible, given every 5-6 months seems to be the going rate for a video. But if you leave me a comment as to whether you want to see more, I will make more. So make your voice heard. If you want more regular content, like market commentary stuff, check out Technical Roundup, second YouTube channel. Hopefully it still exists if you're watching this back in time, or in the future, I should say. But that is all from me. Thank you for the continued support throughout the years. Like, subscribe, comment, call me an idiot, or don't. Be nice for a change. And that's all from me. See you for the next one.